So hello everybody, this is a very big room and a big stage. But my name is Alexandra McGuigan, and I am here with 100 Women in Finance, which is the largest non-profit in the world for the empowerment of women in financial services, and then also Inclusive Asset Management, which is my own company. And in the last couple of years, I've done a lot of work on emerging managers and diverse managers, and there is really an amazing opportunity to seek alpha by using a diverse filter. And we can look at it this way because the barriers to entry are very, very high for anybody to succeed in a financial services or a funds management business. And they are much harder, or the barriers are higher for those people who come from minority backgrounds or women. And so those who survive a 3-year period and reach the hurdles to get to an investable level by institutional allocators can simply just be exceptional investors. And so we can use a diverse filter to identify just some exceptional investors. And today I have a panel with me here who are already using this strategy to achieve alpha. So we're grouping it together, emerging and diverse managers, because generally they fall into the same category. But please let me introduce, I've got Kim Rosenkilde from Singlife, Carol Szeto from CPPIB, and Sophia Tsai from Trinity Church, Wall Street. Now, everybody is here to invest and to make money. That's the whole point, which is why quite deliberately we said Seeking Alpha is the title of today's discussion. But we have here an insurance company, we have a pension fund and an endowment. Obviously they have different stakeholders and have to achieve different return objectives for those stakeholders. So I just was hoping that you could each introduce yourself, your company, and what the investment objectives are that you're trying to achieve.
Well, thank you. I was here this morning speaking, and I think I scared most people away the way it looks. But Singlife is the result of a merger between Singlife, which started out as a fintech, is set out to disrupt the industry, and it did so by acquiring the Aviva interests in Singapore. So there's a little bit of a square peg and a round hole there. We certainly feel very connected to the community. 2 in 5 Singaporeans have some form of touch point with us. And that also gives us a responsibility to the community that we operate in, including the investment management community. 12 billion is what we have in AUM at the moment. We split that up between what we call participating funds and non-participating funds. We also own a very large investment platform, which is called Navigator, which is a B2B2C. So the locals will have a better understanding of that. The financial advisor will conduct his business on that platform, and it's also registered to handle CPF money. So it's another example of how Singaporean responsible we feel we are.
Great, thank you. Carol?
Yeah, so CPPIB invests about 530 billion of Canadian dollars on behalf of Canadians. It's invested across all of the asset classes. We have teams that does direct investment as well as allocating through external managers. So the external portfolio management group, EPM, which is I'm a part of, is our internal hedge fund allocation group. We oversee roughly 57 billion Canadian dollars of capital, and is invested across roughly 50 to 60 different asset manager relationships. The program is global. We can invest both in established managers as well as emerging managers across all of the hedge fund strategies, and it has a focus on alpha. More specifically for our emerging manager allocation, it's also intended to be a long-term investment with the successful managers eventually graduating into the core program in 2 to 3 years after our initial investment.
Thank you very much. Sophia?
Sure. Hi, I'm Sophia Tsai. I invest on behalf of the portfolio of Trinity Church, Wall Street. So the church was the oldest church established in 1697. We have a $7 billion portfolio inherited from a large land grant granted by Queen of England back in 1705. The Queen has granted us 215 acres back then, and the church has given land away and sold some land. We also have given land to King's College, which became Columbia University today. But fast forward to 2015, after owning this single asset for 310 years, it finally diversified. And so now we have half of the $7 billion in real estate and the other half in diversified portfolio. So the investment is to support the church mission in housing, homelessness, and racial justice. So we are trying to have more than 3.25% spend rate, plus inflation.
Wonderful, thank you so much. And so before we dive into the specific programs, or if you don't have a program, how you actually allocate to these groups, can I just get you each quickly to say how you would define an emerging or a diverse manager? Because actually backstage we just realised that we had very different understandings of the definitions. So maybe we'll start again and we'll come back this way. So Sophia?
Sure. So we define diverse-owned managers by 50% diverse ownership or more. That is for North America, that includes women or people of color. But anything that is international is gender only. And then diverse-led managers will be defined as having at least one senior partner as diverse.
Okay. Yeah, so CPPIB as a firm is very focused on diversity and as well as the sustainability of investment, which is related to diversity. We have specific groups that are focused on sustainable investing and governance. Within the EPM group, more specifically, we do not have the DEI mandate, so to speak. But then we do, in our monitoring process, there's been an increasing focus on how our managers are achieving in each of these areas. So we have surveys that we send out to our managers to get a baseline measure of where they stand right now, and we're now in the process of kind of consolidating those information and looking at how we can incorporate this into our evaluation process going forward. And having said that, the EPM team itself, though, is a very diverse group with people with different backgrounds, and there's also a very good mix of females and male investment professionals to ensure that there's a diversity of view in our investment decision making.
And what about the characteristics that you would use to define an emerging manager?
Yeah, so more specific to emerging manager, this is a program that is focused more on early stage managers. This could be managers who are just launching out on their own, or it could be managers who have stayed subscale for a while and they're kind of looking for this next critical mass of capital to grow their business. So the program is led by 𝐻𝐥𝐬𝐿, who is based in our London office. It's a global effort, so we invest, we're active across all of the regions in Asia, in Europe, and in Toronto, and we have local teams based in all of these regions. So myself here in Asia, and Jan in Europe, and I have two colleagues in Toronto as well. The objective of the program is basically to identify managers that we think would be able to achieve scale over time and graduate into our investment portfolio. We can participate in various different stages, and the structuring with the manager are very flexible. So the objective is to achieve an alignment with the manager such that we can have a long-term partnership. So we can invest in the seed stage. This is usually day one startup hedge fund managers. In there, the ticket sizes that we would invest in are usually 100 to 300 million. We will invest in the commingled fund of the manager because this would add the most value in terms of helping them to get to the scale that they need to. The terms will usually have a 2 to 3 year lock to ensure that they have the stability of capital. Obviously, we'll take a revenue share, and we will also ask for future capacity rights. We can also, as mentioned, invest in managers who are subscale. These could be managers that have limited operating experience, very loosely defined as 1 to 3 years, but they could also be around for a bit longer, but for some reason haven't been able to scale, and we can step in as that critical mass. In those situations, we typically can invest either in a commingled fund, or we can structure like a fund of one or a managed account type investment. The terms will usually be discounted fees as well as capacity rights. So I think if you think about the structure from a manager's perspective, I think there are a few key advantages to working with CPPIB as a strategic partner. I think one of that is our experience in the space. So we've been investing with this dedicated program since 2016, but with prior experience in that as well. So the process has been evolving over the years. I think the second benefit, obviously, is the ticket size that we are able to invest in, as well as the duration of capital. So we typically give a bigger ticket up front, and we will also look to increase that capital over time. Which is a little bit different from other seeders who will look to recycle the capital when the initial lock is over. And finally, we also offer advice and guidance to the manager in how they can build a business and some of the operational setup, so that they would usually find that to be useful advice to help them grow and attract other institutional capital, as well as to attract talent.
Great, so you're looking to find the winners early, is what I got from that.
Sorry?
So I said you're looking to find the winners early, because if you strategically partner with someone, you can get in early, and then you can actually reserve capacity in the future. That's one of the key benefits of the program, right?
I'm not going to follow that.
You're not. It's a little bit of an echo up here.
A little bit of echo.
I mean, our bandwidth is not quite as large, clearly, for a myriad of reasons, but it's certainly very impressive. We look at it. It starts with returns. It always has to. And if we can't justify that, then it goes in a different pot, and I don't have one of those pots. So it has to be returns at any given time. When we look at ESG, E is certainly not easy, but there's a lot out there that you can participate in. When it comes to S, it gets a little bit infinite in error, actually, of what you can do. And we're trying to focus on things where, as you well know, Alexandra, we're looking to set up, together with another endowment in town, a women-led long-only group. That's exciting. But again, it's because there's empirical evidence that this outperforms. Otherwise, we couldn't have an interest. So I think for us, that's always the sort of starting block. The other thing I would say is that I was the one who made the mistake of what is an emerging manager, because we co-seeded a long-only ESG fund, Article 9, where the manager is an ex-CIO from Ontario Teachers and ATP in Europe. So it's that credibility that we invest in. But again, with a narrow bandwidth, we also have to accept that riding the coattail of somebody who has infinitely more experience in this is to our benefit. So in the case of 𝐻𝐢𝐬𝐿 in Europe, it was two very large pension funds who's been in the game for a longer time. Here in Singapore, we've co-founded and partnered 𝐻𝐢𝐬𝐫 in a fund of funds, private equity, and 𝐻𝐢𝐬𝐫, of course, being a Temasek subsidiary. We're going into decarbonization partners, again with Temasek and BlackRock. And that's knowing that we can't do as good a job as certainly my fellow colleagues here can. And then finally, of course, as much as we can, if there's performance to be found in our community, then we will sponsor that as well. And I'm certainly searching high and low. It's not always easy. And the final thought is also it takes the same amount of time to make a $5 million investment as it does to make a $150 million investment. It costs the same if I go to Allborn and ask for it to be rated, which I do. So you have to take those economics into the picture as well.
So I'm going to jump to Sophia. So do you actually have a specific program or do you look at it from a returns perspective and then try and make sure that you're allocating from the bottom up? I know you also are involved in IADEI, so I'd like you to explain what that is as well.
Sure, happy to. So for our team, our philosophy, we always believed in market inefficiency, and we have a preference for inefficient markets and differentiated strategies. And because of our AUM is not that large, we think that we can actually find little cracks in the market to generate alpha. And so from the very beginning, we don't have a target for diverse managers or emerging managers. It just naturally happened because when we are trying to look for differentiated managers, it's very easy to find them among the diverse and also emerging managers, because they actually need to show their differentiation to survive. And they hustle more, and they often try to, their size of the fund usually is small, so they were able to find these small pockets of market inefficiency and tackle them. So as a result, without trying to check the box or meeting a target, we naturally, every year when we making new relationship with a new manager, we have invested in at least one emerging managers or at least one diverse managers. And say, for example, for the private equity portfolio that I built from scratch 4.5 years ago, since 2018, 38% of NAV in the private equity portfolio is invested with diverse owned managers. Again, the definition is 50% diverse ownership or more, as a contrast to 1.4% of the 84 trillion asset management industry in the US is managed by diverse firms. So and then we actually try to look at the performance difference, even though 4.5 years is nothing for such a long duration asset class, but we were already seeing like much higher return generated from the diverse managers. Yeah, and you mentioned about IADEI. So I'm one of the 4 co-founders of institutional allocators for diversity, equity, and inclusion. We started that in 2020. And with the goal of directing more capital to the diverse manager space. And we have focused on asset managers, and so we have an open source diverse manager database. So more than 600 members of our organization contribute to this open source manager database, covering both public and private asset classes. It makes it no excuse for any allocator to say, I can't find them. Just go to this database that is accessible. And then secondly, we also try to host different events to put diverse managers in front of our members. So every other month we have the Zoom session. And then I would say the biggest thing is looking into the allocators. Like a lot of time, I think we are to blame when we are not opening and trying to find different sources to look for these diverse managers or emerging managers. And then a lot of time, our manager underwriting process have inherent bias that actually disadvantage the diverse or emerging managers. So we are really trying to look at all these things from different angles and try to improve.
And one of the things, Kim, that we discussed, and I guess in the genesis of the Woman Fund or the aggregated fund, was the limitation that institutional allocators have to allocate to a certain amount of money. So, for example, as you just mentioned, it costs the same amount of money to do a $20 million ticket as it does a $200 million ticket. And even if there is these managers are outperforming, there's limited ability to access that alpha because of the cost the leakage during the setup. So what ways can you all talk about how you're actually approaching that, minimizing that?
It must be. I mean, it's such a tough job being an emerging manager, right? Because when we interview managers, we always ask you how much time do you spend at your desk managing, and how much do you spend trying to raise money. And of course, if you're an emerging manager, you spend quite a bit of time on that, and so that counts against you. The seeds that we've done have been 100 million and above, because we also want to what I think Carol mentioned, we also want to make sure that there's some sustainability in this.
Of course.
That they're around in 4 or 5 years' time. So this, we can't really participate in this drip funding, if you can call it that. And the managers can't survive. Think about how expensive it is to be a manager today, the compliance cost and so forth. So I worry about the smaller managers, and I think in the Women Fund we're trying to bundle it together so we get some means we help each other with the cost, and there's certainly some benefits to that, and we can allocate to a large amount of money without having the risk of just one manager. So
exactly.
That's obviously something that mitigates some of the concerns that we might have had, or the investment committee has.
Carol, do you want to say?
Yeah, no, I would just add that the CPIB's Emerging Manager Program is very selective and also opportunistic, and part of the reason of that is identifying that manager who is scalable, who we can grow our capital with, is not always easier, especially if you look at Asia region. A lot of the capital markets here are still growing, and so a 1 billion manager might be a small one in the US, North America, but in Asian markets it's actually a huge manager, and so that's always one problem that we come into. But I think the other aspect of it is also just people not recognizing that a lot of the managers that come out and come out on their own independently, one of the issues that they may struggle with is they might have managed that $50 or $100 million that they were given when they were on a platform or as a sub PM within their firm. They wouldn't realize that they would be able to scale up their strategy to a much bigger scale if they were to run on their own, if they have the right team in place, if they have the right infrastructure, and if they have the right backers behind them.
Great.
Can I ask you a question?
Go ahead,
Sorry, I didn't hear before. Do you ever get a GP stake?
We do not take GP stakes,
right.
So only revenue share, and we don't. I think the program does not try to maximize the standalone value of the revenue share. It's basically a way for us to reduce the management fee, in compensation for taking the additional business risk in an earlier stage manager.
Right. Okay. Thanks.
And do you take a GP stake, Sophia?
One thing I just wanted to add is that having invested in so many diverse and emerging managers, I think it actually built a competitive edge for the allocators. I think they are actually have become the source of the next best diverse managers and emerging managers for us. And it saved me so much time when I chat reference with them, because I actually rely more on GP reference than LP reference. No offense to my group, but I think they actually were able to tell me the bedside manners of other GPs, how they deal, how do they retrade, all that stuff. So I think it's actually becomes a competitive advantage having that kind of manager ecosystem.
And then, to that point, how do you actually source these managers? Because a lot of emerging managers, as Kim said, to be an emerging manager and to actually get to scale, you need to be an operations person, a compliance person, a salesperson, and an investor, and achieve exceptional investment results for 3 years, which is a pretty hard task. So you very rarely have time, and I've worked with big fund managers and had products rated by asset consultants, etc., and it takes a very long time to do that. And so if they're not on the databases, how do you actually find these very good managers? And then how do you actually compare them to make sure that you're picking the best of the emerging managers?
I would say that we use SBAI a little bit for that. They have an emerging manager program. But again, you highlighted all the difficulties the managers have to go through. And when you put them, let's say you find someone and you think you can sort of industrialize their size, or institutionalize, whatever what you want to call it, but then you take him to get rated at an Auburn or somewhere else, they're always going to have a problem on getting a good grade because they don't have the track record, right?
Yeah.
Even the Q Blue Fund that we've helped start in Europe, the manager has won whatever lifetime award in pension industry and so forth, but the fund doesn't have the track record. So therefore, the management will always be judged on the track record in this fund. So the system is also not helpful to a new manager. But SBAI is one, and I don't come from the insurance world, nor do I come from investment management. I was in markets, so I know a few people who started up their own, and you talk to some of them. By the way, an insurance company has quite a bit of limitation in how many sort of hedge fund products we can invest in and other alternatives. So that also limits us, hence our focus on some of the traditional long only.
Did you want to say?
Yeah, sure. So endowment foundation actually is quite notorious about sourcing managers among ourselves, but ending up like when there's a small manager or emerging managers having several endowments, foundation is all and suddenly like really crowded that capacity, and they all go in at the same time, and then when one leaves, then everybody leaves. So I came from a corporate pension background, and now having in endowment foundation, I found that actually the best idea is not necessarily is first reaching out to other peers. In fact, I have sourced, very successfully for the last few years from channels that is outside of ENF community, including iConnections and 100 Women in Finance. So I found our new long-only China manager headed by a female PM during COVID, because I sought her out from 100 Women in Finance iConnections virtual event in 2020, and we became their day one investor when she launched in July last year. And then our emerging and diverse manager ecosystem, I think that is another best sources of ideas. And there are so many of events that are being hosted by organizations nowadays, I would say. A lot of my venture managers, I was able to find them through like the speed dating event organized by First Republic Bank or some other organizations. They would just put forward 6 emerging managers or diverse managers every other month in front of allocators. So I think there's no shortage of channels to find and access these managers. It's just whether you're willing to do it.
And we only just have a few minutes left, so I just wanted to ask a few questions about IADI in case there's anyone in the audience who wants to join. But the database is for minority and female-owned funds. Is that right? So fund managers can apply to pitch to IADI, and at the moment it's a list of something like 400 allocators, mostly based in the US?
So feel free to go to the iadei.org website, and managers can send in an inquiry form and saying that this is my strategy, and then we could decide whether to add it to the database that is accessible by our 600 plus members. But mostly the members actually add those managers directly to the database. Again, it's an open source one.
And then for allocators who aren't based in the US, can they also join so they can access?
Yeah.
Yeah.
Yeah, definitely.
Anybody can.
Right now we don't charge any membership. It's like we try to have more members and just benefiting the mission.
Yeah, well, it's amazing work, and I'm just going to thank you all very much for being here today. Did you want to have any final comments?
I was just thinking about if I was a skilled hedge fund manager, and I can assure you I'm not even close to being qualified for that. Instead of walking around town trying to get money, I can walk into Millennium or any one of those, and you know, if I can work within their risk parameters, all I have to do is just invest. The emerging manager world has that to compete with, and the more we see of these multi-managers,
Yes.
the less I think we will see of the emerging. And I kind of understand that. Again, I unfortunately don't have the skill, hence I'm sitting here today. Get it?
Yeah, I would just say that I think, like, just like launching a business, I think, like, you know, launching your own fund always seems like a daunting idea in itself, especially, you know, if you have like a background from a big organization, you know, the backing, the capital is almost something that you take for granted. And I think some people aspire to it, but just how do you go about that process? I think the initials of trying to get around, like, you know, who you should be speaking to, what do you need? I think that process, in order to get it started, it's not something that is always straightforward. So I think, like, you know, one thing that CPPIB makes sure to do is we like to speak to managers as early as possible. So even if they don't have, like, you know, a very concrete ideas, but the minute that they have, like, you know, something in mind of launching on their own, we're happy to start having dialogues with them and kind of guide them through that process. Like, you know, a lot of times this may not actually come to fruition, but it's just something that, you know, we do like to speak to people about.
Amazing. And
I would say the last few years, we have seen incredible bull market, right? I think rising tide lifts all boat. It's hard to show the differentiation, but like, I think in turmoil and volatile markets like today's, I think is where differentiated managers can shine. And so, you know, I know this is a very tough fundraising environment for emerging managers, but don't be discouraged. And I think, you know, if you show your differentiation and competitive edge, I think the allocators will find you.
And I'm just going to leave you on that point. There was an article last week, and I'm obviously Australian, you can tell by my accent, but there's an industry magazine called Financial Standard, and they've come out and said that from the study that they did, that female-led fund managers and co-led managers have outperformed in the market downturn. So it's a good diversifier and potential return enhancer. So thank you all very much, and enjoy the rest of the conference.